Good afternoon, everyone. This is Mark Robertson with the 506 Investor Group. Today we have another in our series of webinars with sponsors. And today we have Larry Gross with Structure Capital, who's going to go over the Fund 2 and then also the results of Fund 2 and then talk about Fund 3, which has just launched. Welcome, Larry.
Thank you, Mark, and thank you, everybody, for participating. And this is our third call, so thank you for those who have joined in the past and new callers who have, this is the first time. We just wanted to give you an update from our call a couple of months ago about Structural Capital and where we stand on Fund 2 and the launch of our third fund. So as you can see here on the screen, it's been a very exciting past couple of years with Fund 2. We now have over $170 million of assets under management. We have 17 investments, and we have a tremendous pace of investments, which I'll talk about later. Fund 2 is marked at a 22% gross IRR. We think there's even some upside in the warrant values that we have at that marking. Fund 1 is similar. And we've had 6 realizations. The exciting one that the fund hasn't realized, but it was an IPO a couple of weeks ago, was the Beyond Meat investment that we made. And I think that has been, people are talking about it. The IPO stock price was 25, and I think today it's trading close to 80. I'll take a look. But it's one of the most successful, it's over $80 a share today with the market down 300. One of the most successful IPOs maybe in the last 20 years. So it's very exciting. A company, we've done very well with it, and it'll be a good results for our Fund 2 investors. In addition, we had 6 other realizations in Fund 2, and like I said, that the warrant positions that we have could boost these IRRs even further. Some of the recent transactions that we have done, obviously Beyond Meat going public, but we also have done 4 other deals recently, including 2 here in May. The most recent ones I'll talk about are Urgently and Boosted. Urgently was a add-on refi to an existing investment. They are a company that essentially provides on-demand roadside assistance. Think of like Uber for tow trucks type of thing. They have arrangements with Mercedes-Benz, BMW. I think they're working on 2 other big names that I can't mention right now, but the company's doing extremely well, and we had made them a previous loan, and now we've increased the size of that loan to $10 million. Similarly, we made another investment in a company called Boosted, which for those of you who see all the electric scooters around the streets, they're a manufacturer of it. And they also made electric skateboards, and the investment size was $17 million. We did 10 in the fund, and co-investors did 7 in addition to that. Here are just some confirmations of the type of companies that we're investing in that have these paths to profitability. You can see these are later stage companies that we're investing in. You can see the revenue range of the type of companies, 20 to 30 to 50 to 80 to 100 to 250 and 350 million in revenue type of ranges. And you can see the type of quality sponsors that are involved in the companies that we're investing in as well. Here's an overall summary. These were the audited, well, it says unaudited at the top, but it's actually audited now. The numbers from Fund 2 as of December 31st that we sent out for those of you who are Fund 2 investors your year-end audited financials. So Killapass is a company that we had a full exit on. A public NASDAQ company acquired that, which is why that's listed as fully realized. And then we had 4 loan payoffs, but we still hold the warrants. You can see the nice IRRs there. And then the debt-only yield to maturities of the unrealized and subsequent closings to December 31st are all listed below. And you can see that they're all in the sweet spot of what we're targeting for our investors. So we just made our last capital call. We believe is our last capital call about a week ago. It's due May 29th, and that will bring people up to 100% capital called. There was a question about capital that we've distributed that is recallable, and that is a possibility, but we will likely not do that, is our intentions at this time. However, if another possible transaction comes along and the timing is such that we can do that still within Fund 2, we will do that. The intention, though, is to make our final investments, which we're making right now in real time in Fund 2, and then do a clean cutoff after that in June 15th in order to launch the third fund, and then all new deals will go into the third fund.
A quick question on Fund 2. If we committed $100,000 and then we've paid in and all the different capital calls, so this last capital call is 100% of our capital, but do we actually have 100,000 invested, or have you returned some, so it's actually less than that? So what capital, if I invested $100,000, what is owed to me right now according to your books?
I'll have to get the exact number, but I think the $100,000 has been called. We've invested it, or are investing it, and I think only $6,000 of the 100, so 6%, would even be subject to recallable for new investments.
But you haven't.
So,
but if it's
which we have not called, and we don't plan on calling it.
But you haven't sent money back to us that has decreased our capital count. If we committed $100,000, right now our capital count balance after this last call is $100,000. Is that true? It kind of confuses me.
Well, we have sent back $6,000. That's 6%.
Yeah.
That,
so 94,000 would be our capital balance right now if we invested 100, give or take, or 100,000.
Well, we'll be. By the way, we're going to be sending out Q1 account statements in the next week, so you'll have the exact numbers.
Okay.
But it's in that ballpark. Yes. So, by the way, we send out audited financials 85 days, between 85 and 90 days after the end of every year, and we send out the quarterly unaudited financials 60 days after each quarter. So that's why you'll be getting that in the next few weeks here.
Oh, very good. Thank you.
So the idea is we now will be focused on Fund 3. This is a $250 million fund. It's larger than our previous fund. The reason for that is, as you can see from this page, in the column of total deal size, the sizes are getting large, whereas structural capital commitment is never more than $10 million. So we have concentration limits that we abide by, so that we never have too much in any one portfolio company, and we have a nice diverse portfolio. Since the deal sizes have been growing, you can see Derive was $30 million, Affinity was $60 million. We're working on a $36 million deal right now, where we can only hold 10. it would be nice to have a larger fund where we can hold more in the fund and we don't need to seek co-investors in order to consummate the deal. All of these deals are deals that we've sourced, that we are the lead, that the loan docs are our docs, that we control, and we just need co-investors sometimes in order to make the deal size work. And so the $250 million fund size will help us hold more in the fund. The other question about the capital call for the fund will be sometime in late June. We would like to get all the subscription agreements in place by June 15th. We originally said here in May, but it's been pushed out to June 15th. And then we will make the initial capital call sometime in the end of June there. As always, it'll take we'll allow 10 business days to fund that. So that'll be sometime into July. And we anticipate that that first capital call will be a 8 to 10% commitment. So if somebody committed $100,000, $8,000 to $10,000 will be that initial capital call. And that roughly will be the type of capital call that we will make quarterly over the subsequent 10 to 12 quarters, because it's a 3-year investment period. So it'll be rather gentle over the 3-year investment period. And many people have asked, well, if I'm a Fund 2 investor, for those who are, to Mark's point that he just raised, a lot of these monies are going to start coming back from Fund 2 at this point because we've invested it, and now we're having exits like Beyond Meat and others where the monies are going to start coming back. And at this point, we start sending all of the capital back, not just the interest payments. So the money is going to be coming back from Fund 2 investors at a pace that could match or even exceed the capital call schedule for Fund 3. So to some extent, obviously there's taxes involved there as well, but to some extent, those distributions from Fund 2 could largely fund Fund 3 commitments.
What's your best guess of the amount of capital that's going to return from Fund 2 in the next 12 months as a percentage? Do you think 10%, 25%? How much of equity will be coming back is your best guess from Fund 2 during the next 12 months?
We have a couple of big companies on the horizon who are doing extremely well, and I think that's all I can say about that publicly.
Yep.
But let's just say that the distributions from Fund 2 are going to be attractive over the next 12 to 18 months.
All right. So we don't know how big a number is, but it's definitely some equity will be coming back. Well, if all
yes.
Oh, yeah.
Yes. Yes. Well, once the investment period ends in our funds, we return all the interest payments, all the principal payments, all the warrant gains, everything that we get from these companies goes back. So we're getting into that phase now of Fund 2. So during the investment period, we've just been doing an 8 to 10% type of distribution just to give an annual coupon. But now we're getting into the phase where everything starts coming back.
And in the last 12 months, what percentage of the portfolio actually went full cycle? Had deals that paid off their loans? Well,
in the last 12 months, well, you can see on this schedule, the only loan repayments we had were the top 4, and those were in 16 and 17. But we did have Solaria, which is in the subsequent closing, and Urgently do a second loan with us by paying off their first loan and doing a new loan.
Gotcha.
So that's what has happened in this year. So it's about Urgently was $10 million, and we may have another company that's going to do that. So could be 10 to 20 million in
And
that
the average
category.
term is 3 to 5 years. Is that correct?
Our average loans are 36 to 48 months.
3 or 4 years.
We don't really go longer than that. And as you can see from the loans that did pay off, they really were only outstanding for less than 2 years.
And we made quite a bit in 16 and 17. You made a few loans, so those
yes,
coming close to the maturity in the next 12 months.
Well, what happens is, and this kind of validates our strategy, is we're investing in these later stage companies that have significant revenues and products and customers. These are not companies with ideas on a napkin or anything. And they're not quite into the EBITDA end zone yet, but they're on the cusp of it. And so they want to pour more gas on the fire and get there in a less dilutive way. And that's what our solution is. And really, there's more demand for what we have than capital that in funds like ours. So it's something that we believe is really a ripe sector in good times and bad. And once they get into that EBITDA end zone, then they have less expensive alternatives. And so they will typically refinance us out. Even though it's a 3-year loan and they're in year 2, they can get less expensive capital than we are. And so it's a little bit bittersweet for us that they pay us off for early, although there's prepayment penalties and things like that. But we would prefer to have the loan outstanding longer. However, because of the amount of deals we have in our pipeline, we can recycle it into the next deal just fine. And we get those nice end of term and prepayment penalties. So it's good for us as well.
Very good. Thank you.
One of the questions was, how has the institutional demand evolved since our last webinar? And the answer is very well. For those who don't know how the institutional fundraising market works, is you have big endowments and foundations and pension funds, and there's also a lot of consultants in the industry who advise these big institutions on what they should do. And it's a very long process to go through these consultants to get approved. And then once you get approved on the platform, then the floodgates open, because if a big consulting firm says, we've reviewed and done due diligence on fund XYZ, and it's good and we recommend it, then all these institutions kind of pile on. And so that's where we are right now, is we are very far along. I'd say multiple years we've been talking to this one extremely large consulting group, and they are about to make their final push with us on due diligence. It's all going very well. And so the numbers that they have thrown around as to what that could mean with their clients is huge. I mean, we're talking 9-figure numbers. So that's why it's good that many of you on this call either have invested with us or are contemplating investing now, because once those consulting groups put us on their platform, then the big institutions will be rolling in, and we anticipate that happening soon.
And what's the commitments to date, though? Do you have a ballpark on how much?
This first closing should be just shy of $100 million. So somewhere in the $75 to $100 million range.
And refresh our memory, this is for qualified investors only.
Yes.
And the minimum is how much now?
100,000 for the 506 group. Yeah. I mean, the minimum is really $1 million, but because so many 506 group investors have collectively invested, we're able to do it for 100,000.
All right.
And just group everybody together into the 506.
And still the best way to invest is to reach out to you, or you have someone you'd rather
Yes,
deal with that?
yes. My email is larry@structuralcapital.com, LARRY@structuralcapital, 2 words, no spaces, no, all lowercase, doesn't matter about the case. And I can send you our prospectus, PPM, and subscription docs, and this deck as well, if you're interested. And then you can just return that to me, and then we'll get you into the system.
And do you think any of the companies that are in Fund 2, you'll do follow-up investments from Fund 3? Is that normally how it would work?
We'll shy away from that. That we don't anticipate doing that. We really want to have a clean break between the Fund 2 portfolio and the Fund 3 companies. So we don't anticipate doing that.
And are there any loans in Fund 2 that you're worried about?
No, actually not. There was one company that we had been slightly worried about given the trade war that's going on between our country and China. It was the company Solaria, which makes solar panels for the residential solar market. And because tariffs were put on imports from China, things got delayed in their sales cycle, and the channel got plugged up with lots of inventory before the tariffs went into place. But that happened a year ago, and it's all worked its way through. And actually, we extended an additional loan to Solaria because they're doing so well now. But that was the only company.
Is only $3.3 million. Is that what it says here?
Yes, the second loan was $3.7 million. Yeah.
Oh, yeah, there are 2 loans. Yeah, but the current exposure is 2 on one and 3.3 on the other.
Yes.
And on this sheet here, the current exposure is 81 million plus the 47. Is that the total, or is that unrealized subsequent closings?
The 81 is adding that whole column up.
So 81 million is what is currently out as loans.
Yes, but you can see that's on $263 million worth of deals. Yep. So we've originated $263 million worth of deals, which is why we'd like to raise a larger fund so we can hold more of it.
And Fund 2 ended up the fund size was how big at the end?
It ended up with the co-investments that we manage in the fund, like I said, about 170 million of assets under management.
But our exposure is 81, so where's the difference, the delta?
The current exposure is the fund, and then there's the co-investment exposure. Yeah.
All right. Any other questions from the group? Is there anything else you'd like to add, Larry?
No, we've enjoyed our partnership with all of you, and we would be honored to be partners with you again in Fund 3 if you choose to invest.
All right, and recap the deadline for Fund 3 the next June, July, is that what you said?
Yeah, well, we're going into a holiday weekend, and we're wishing all of you a wonderful Memorial Day weekend. So if people are interested, just shoot me an email, and as long as you can get things back to me by June 15th, then you'll be all set.
And about 10% for the first close.
Maybe 8, yeah.
Okay. Yeah, but ballpark. All right. Well, thank you so much for your time, Larry, and and this is recorded, so I'll share it with the rest of the group who couldn't be here live, and we will be in touch. Thanks for your time.
All right, thank you. Bye. Talk to you all soon. Bye.
Anybody Anybody want to comment on Fund 2, Fund 3? Not a lot of bunch of new information, but there's nothing bad going on in Fund 2, which I guess is good information. Good news. No problem children in the portfolio. Sounds like we'll get a substantial amount of equity back in the next 12 to 18 months. So it might actually make sense to reinvest that in Fund 3. That's what he hopes for anyway, it sounds like.
Hey, Mark, do you think it's the same story on this one as before, that we could invest late and return the interest for the period that we waited?
Yeah, I mean, I think he's obviously dangling the huge institutional money that may come in and wants us to invest now, but
Okay.
I'm sure we'll have warning if we want to go in later. So I don't think there's
There's going to be multiple closings. I guess that's what I
there's going to be multiple closings.
Okay.
Yep. I mean, the difference between this and SQN, they're actually giving you an incentive to invest early because they're doing a 10% pref instead of 8% pref during the first 120 days. But to my knowledge, there's no incentive either way on this fund.
And did I, cutting to the chase, I mean, he wasn't obviously committing to anything, but was he alluding to I think it was a fund level though, a 20 or 22% IRR for Fund 2?
If he said that, I missed it, but it's very possible. I didn't. I mean, I know that it's with warrants and stuff. I think he's always said 15 to 20. So if things are going really well, I guess he could have said that. But
yeah, I don't remember what the spread was between fund level and LP level.
Oh yeah, with all the promotes and fees and stuff. So
Right. Yeah.
22 could have been gross for the fund. And
That's what I would have guessed you were talking about. So I was guessing it was something about 22, and it might be 15 or 16 does.
Yeah, I mean, I don't think he's ever said that we could get 22. So I'm thinking 15 to 18 is probably a realistic expectation.
Right.
But the good news is there doesn't seem to be any problem children. I mean, the solar thing kind of scares me because I know solar stocks are in the tank, but he says they're doing well.
That's interesting. They did a 3.7 more.
Yep.
I think he was going to say they paid it off.
Yeah, I mean, it's actually pretty significant if it does go south because we've got 2 loans with them, and we only got 81 million of exposure, and it was over 5 million between it. So,
Yeah. Okay.
But I know nothing about that company or their business, so I have to take his word for it. All right, anything from anyone else? If not, this one's in the book. Thank you, guys.